Well, good afternoon and welcome everybody to the New York Alternative Investment Roundtable's December virtual event entitled Post-Election Tax Considerations 2020 and Beyond, a broad look at tax atmosphere on asset management, including its impact on charitable organizations. I'm Alessandra Tocco, president of the Roundtable, and we're glad you're able to join us this afternoon. First of all, I'd like to take a moment to thank the Roundtable sponsors. We're glad to have such a wonderful group of sponsors who are so actively involved in the industry. This event is being done via webinar, so you will not be able to see the other participants, but you can ask questions to the panelists through the chat function or the Q&A tab on the bottom of your screen, and we would encourage you to do so. Before we begin today's panel discussion, we're going to start the event by highlighting two important charities, Just Capital and the Leukemia and Lymphoma Society. To kick things off, I'd like to introduce Martin Whitaker, the founder and CEO of Just Capital, where he is responsible for overall leadership of the organization. He is the co-founder and board member of the CREO Syndicate, a family office investment network, a board member of the Carbon Disclosure Project US, a member of the Forbes Finance Council, and a Forbes contributor. He was recently named to the 2020 NACD Directorship 100, the annual list of the most influential people in the boardroom and on corporate governance, and to Business Insider's 2020 list of 100 people transforming business. Prior to his current role, he was a founder, partner, and investment committee member at impact investing firm Sonnen Capital, where he led private equity, real estate, and direct investment opportunities. And before that, he had several directorship level roles at Mission Point Capital, a family office-led private equity firm, Swiss Re, and Innovest Strategic Value Advisors. And now I'd like to turn the virtual floor over to Martin for a few minutes. Martin.
Thank you, and it's a great pleasure to be here. Apologies in advance, of course, for barking dogs, roaming children, noisy neighbors, etc. Well, look, I wanted to talk about three things that relate to Just Capital's mission. But before I do that, I just want to give you a very quick background on why we exist. We were founded 7 years ago by Paul Tudor Jones and Deepak Chopra. And the idea really, in a nutshell, was that philanthropy by itself was facing an uphill battle in addressing major societal challenges. And without the private sector on board, without the private sector pulling in the same direction, we were just, it's going to get harder and harder, and philanthropists like Paul were finding things, incredibly challenging. And so the question really was, how do you create a race to the top? How do you incentivize, in our case, large corporations to really, acting out of enlightened self-interest, do more to address and create value for all of their stakeholders, their workers, the communities where they operate, their customers, the environment, and of course, their shareholders. And so our thesis really is that if a company is good at doing those things, it will be successful overall, but it will also begin to address some of our more intractable social and environmental challenges. The resources of the private sector are enormous. The business case, the investment case, which is one of the things I'm going to talk about, is highly compelling. More and more investors now seek companies that do well on ESG factors, but it's also a very complex environment. Data is lagging, and it's very difficult to know really who's doing a good job and who isn't. That's where Just Capital comes in. We have spent 7 years now building our platform. We essentially do three things. We capture the voice of the American people in great detail. We travel all around the country, or we did up until 2020. We do focus groups, quantitative survey work, public opinion research, polling on all issues of the day to really try and capture how America feels about companies today and the underlying issues. So that gives us the playbook for what to measure. And this year, of course, that's been an incredibly insightful aspect of our work as we learned all about people's attitudes to COVID, to racial equity, to closing down the economy and reopening the economy. How does a company navigate that? The second thing we do is we gather data on how companies, large corporations, do on all those issues. And we track company behavior, we produce ratings and rankings and analysis and research that objectively measures company performance on America's priorities. And then the third thing we do is we package all of that into tools and products and media, content and stories that drive change, which is ultimately the mission of the nonprofit. As a 501c3, our mission is really to drive private sector change and in doing so, create outcomes on critical societal challenges. So let me talk about the first aspect of that. We found this year, we might look like a country divided in terms of our politics. We are not a country divided when it comes to how we expect business to behave, what we want in terms of being able to take care of our families, put food on the table, have good jobs and a good work experience, and our expectations of business today. We found a lot of agreement across political ideology, age, location, race and ethnicity, economic background. 80% of the American people today want and expect business to do more. Almost 90% see 2020 as a moment to reset our thinking on that. So I think the door is open for new thinking about how the public sector and the private sector can work together, for new thinking on the role of business in society and how companies can really begin to address the needs of the majority of Americans. So that's number one. It's an area of unity, and I think it should give everybody, I hope, a sense that there is some things we can agree on. Second area is around the business case. Over a year ago, America's largest corporations, signatories or members of the Business Roundtable, signed a new statement on the purpose of a corporation. Now, this has been sort of dismissed by many as just business as usual, greenwashing, or just mere, empty rhetoric. And we don't think so. We're tracking what businesses are doing on all those issues that I've just described. How are they creating value for their respective stakeholders? And what we found is that actually many, many companies are doing a lot to change. It's a process that takes a lot of time. It's a mixture of different kinds of incentives depending on different industries, but we see businesses lifting wages, investing in climate change measures to reduce greenhouse gas emissions. We see companies taking extraordinary steps to change the way they look after their workforce, especially in 2020. And since the summer, since George Floyd, we've seen companies begin to take unprecedented actions to promote racial equity in the workplace. And this is just the thin end of the wedge. This is just the beginning. I'm an optimist, which is why I do what I do. But when you look objectively at the data, you can see company performance changing. And I think that needs encouragement and incentives. And that's what Just Capital's mission is to do. The third thing I want to talk about is the business case. The investment case for leadership on stakeholder value creation is compelling. Our baseline index, which we licensed to Goldman Sachs, we launched an ETF in 2018, has outperforms the Russell 1000 consistently by about 100 basis points a year. It tracks the Russell benchmark. We're licensing our data to investment managers across asset classes and across strategies. And the hunger for real authenticity on ESG data and on just performance of underlying companies, I've never seen anything like it. And I've been in sustainable investing for 20 plus years. So I think the world is changing. We see, even over this summer, companies that invested in their workforce, who were more resilient coming into a pandemic, have been more successful through the pandemic, and are now writing the playbook on what it means to be a successful company on the other side. So I think the way we define success, the way we think about companies today, is fundamentally changing. and the encouragement that we, Just Capital, as an independent nonprofit, can bring to that to showcase leadership is crucial. I'm going to leave you with this thought. The work we do with PayPal is an example of a concrete program to address economic hardship for full-time employees of large companies. Just typifies everything we do. That program essentially just asks CEOs just to do an assessment of their workforce to know how many of their workers are at or below a living wage level. You'll be surprised how many CEOs and how many companies don't even know that. Those full-time workers are not particularly productive in the workplace. They're having a hard time making ends meet. Many of them rely on government support to feed their families. And the question really is that right? Is that a sustainable business model? So we've asked that of companies just to do an assessment, and PayPal, and before PayPal, Aetna, under Mark Bertolini's leadership, had done that. And the implications for the lowest paid workers and their families and the communities where they live are enormous. And there's a massive win-win with business too, because worker productivity goes through the roof. And we've seen that with the data from those two companies and other data as well. So our partnership with PayPal, Financial Health Network, Good Jobs Institute at MIT is all geared around a win-win. What's good for business, good for workers, and good for shareholders, but really, really good, most importantly, for the hardest hit, most economically challenged workers, full-time workers today. So that brings our mission home in a nutshell. I'm grateful for the chance to talk about what we do. I know it's a little unusual for a nonprofit, but operating at this intersection of finance, business, and philanthropy has been a privilege for me, and I'm happy to follow up with anyone who's interested in what we do through justcapital.com. Thanks again for the chance to talk today.
Thank you, Martin, for sharing your thoughts. You're doing very interesting things at Just Capital, and I'm sure the audience was as interested to hear it as I was. Next up, we're switching topics just a little bit, but I'd like to introduce to you guys Dr. Lou DeGennaro, who is the president and CEO of the second organization that we are spotlighting this afternoon, the Leukemia and Lymphoma Society. Dr. Lou, as he's affectionately known, is a global leader in the fight against cancer and has been a member of LLS's executive leadership team since he joined the organization as its chief scientific officer in 2005. As a key architect of LLS's Cures and Access agenda, Dr. Lou conceived and pioneered LLS's Therapy Acceleration Program, a venture program approach to accelerating new treatments to patients through drug discovery and development partnerships with the biotech industry. Dr. Lou has devoted his career to saving lives through drug discovery, having begun his career in academic research before later moving into drug development at several pharmaceutical companies. Prior to joining LLS, he held academic positions at the Max Planck Institute in Munich, Germany, and the University of Massachusetts Medical School. He also served as a senior director for molecular genetics for White Pharmaceuticals and is an executive vice president at Synex Pharmaceuticals. And with that, I'd like to turn it over to Dr. Lou and tell us a little bit about LLS and the great strides that they're making to cure cancer. Dr. Lou?
Thank you so much, Alessandra. I want to thank you and the organizers of the roundtable for this opportunity to tell you a little bit about the Leukemia and Lymphoma Society. I've got a few slides to share, so I'm going to share my screen and walk you through them quickly. And let's see if I can make this work. Here we go. So let's move right along here. I'm very proud of the fact that the mission of the Leukemia and Lymphoma Society begins with the word cure. And the mission is here for you: cure leukemia, lymphoma, Hodgkin's disease, and myeloma, and importantly, improve the quality of life of patients and their families. So our focus is what's called the hematological malignancies, the blood cancers, cancers like leukemia and lymphoma and multiple myeloma that begin in the bone marrow and affect the blood. We're an organization that was founded 70 years ago by a father and mother who lost their 16-year-old son to leukemia. And it was their grief, really, and the fundamental desire to never have another family go through the same experience they did, that took them to form the organization. I have a document they wrote in 1954 that lays out the goals and objectives of what is today the Leukemia and Lymphoma Society. They're still very relevant, and I'll just tell you what they were. Raise funds, support research, find a cure, and assist needy patients. Those were precisely their goals and objectives 70 years ago, and they continue to be ours. And you can see that reflected in the 3 pillars through which we deliver our mission. Innovative research, we fund research in academic centers all around the world, and through the venture philanthropy program that Alessandra mentioned, we also partner with small biotechnology companies to fund research and drug development. We have patient-facing programs that include patient education, patient support, financial aid for patients. And I'll tell you a little bit more about that in a minute. And then finally, policy and advocacy work that we carry out in Washington, D.C., and in state legislatures around the country, trying to educate legislators about what's important to cancer patients writ large, not just blood cancer patients. We are today and I think our founders would be very proud of this, we are the 2nd largest cancer-focused not-for-profit in North America, with $400 million in annual revenue. You should know that this is 100% private donations from peer-to-peer fundraising events that we run, from corporate sponsors, corporate donations, and from gifts from wealthy individuals who have a desire to see us move the needle for the blood cancers and, frankly, for all forms of cancer. So let me tell you that's part of the why, but let me take another step and tell you more about the why. There's a critical unmet medical need for the blood cancers. Every 3 minutes, an American is diagnosed with one of these blood cancers. When you take them together, leukemia, lymphoma, myeloma, and the other blood cancers, they're actually the 3rd leading cause of death by cancer in the United States. Every 9 minutes, an American dies from blood cancer. Across North America, 1.4 million people are living with the diagnosis of one of these diseases. We've made tremendous progress, and I'll tell you a little bit about that as we go through the rest of this presentation, but still 30% of blood cancer patients don't survive 3 months beyond, they don't survive 5 years beyond their diagnosis, their initial diagnosis. When you hear the word leukemia, you think of children, of course. Actually, 10 times more adults get leukemia than children, but nonetheless, leukemia represents 40% of all pediatric cancers, the cancers that affect children. So you can see there's a clear unmet medical need here, and it's finding solutions for these diseases, finding cures and treatments, and making certain that patients have access to these treatments that drive everything we do at the Leukemia and Lymphoma Society. So what have we been up to? In terms of innovative research, thanks to our very generous donors, we have been able to invest over $1.3 billion into research worldwide. I think at this point you'd say, well, what'd you get for it? And I'll tell you what we got for it. In the last 3 years alone, the FDA has approved 66 new treatments for the blood cancers. 66. And the Leukemia and Lymphoma Society has been responsible, our research funding has been responsible for discovering or driving 57 of those newly approved treatments. Now, I don't suspect there are any drug developers on the call today, so let me put this into context for you. Historically, 1 or 2 FDA approvals of new drugs to treat blood cancers would be good. I can remember one year, about 10 years ago, when there were 3 FDA approvals in a year, and frankly, I was dancing on my desk. This was a tremendous achievement. To have 66 newly approved drugs, and these are not just incremental improvements, these are groundbreaking treatments that are saving patients' lives. no matter how you consume your news, in the last few years, you cannot have failed to have heard about immunotherapy and the impact of immunotherapy, CAR T immunotherapy in particular. This was pioneered and developed in the blood cancers, and now is providing benefit for patients not only with blood cancers, but other forms of cancer as well. On the patient support and education side, I'm very pleased to tell you that since 2007, we have distributed well over $500 million to needy patients through a copay assistance program that we have that allows them to access these incredibly powerful new treatments. We have a patient support group that answers our 800 number, chat line, any way patients want to connect with us. In this past year alone, we have engaged 25,000 patients to provide them with additional information about their disease, how to deal with it, how to get the right resources, how to get to the right physician and get on the right treatment protocol. And on the advocacy side, I'm very pleased to tell you, we have 50,000 advocates across the country who partner with us on a regular basis to help raise the clarion call to legislators about what patients need and how legislation can be passed to be in the best interests of cancer patients. Right now, we're focused on the cost of cancer care. Look, the good news in what I'm telling you is that there have been many new breakthrough treatments, especially for the blood cancers. The sad news is they are very, very expensive. And we need not just to solve the science side, the cure side of the equation, we need to solve the access side of the equation as well. And that's why the Leukemia and Lymphoma Society works in the advocacy space as well. Now, I just want to finish up my comments by illustrating all of what I've just said through a story. And the story really focuses on a patient, and she's in the middle of this, slide. Her name is Erin Zamet-Ruddy. And nearly 20 years ago, Erin was diagnosed with a leukemia called chronic myeloid leukemia. Now, shortly before her diagnosis, patients were being told that their life expectancy with a chronic myeloid leukemia, a CML diagnosis, was 3 years. We didn't have particularly good treatments. The treatments that we had were ineffective, and patients lived on average about 3 years after that diagnosis. The gentleman to the left on this slide is Dr. Brian Drucker. With the Leukemia and Lymphoma Society funding, Dr. Drucker discovered and developed a new drug that's called Gleevec that was approved by the FDA about 6 months before Erin was diagnosed. Now, the beauty of this drug is multifold. First of all, it's an oral therapy and can be taken at home by the patient. And the side effects are quite mild, and the drug is extremely well tolerated. Erin was lucky enough to be one of the first patients on this drug. Today, unlike what happened 20 years ago, today, when a patient is diagnosed with chronic myeloid leukemia, they don't get a death sentence from their physician. They're handed a prescription. They go to their local pharmacy, they fill that prescription, they treat themselves at home, they live long, healthy, productive lives. The average life expectancy of a CML patient diagnosed today, a 55-year-old CML patient diagnosed today, is 30 years. So this is a remarkable new advance. Erin has gone on to have a remarkable life and career. She was able to have 3 children. She is a successful author and journalist. She's had a long, healthy, and productive life. The major hurdle for CML patients today is not life-threatening cancer, it's how to pay for this drug. And so we continue to focus, we've had, part of our focus has been on legislation across 43 states driving what's called oral parity, so that patients don't experience high out-of-pocket costs when they're treating themselves at home with a drug like Gleevec, where they don't have to put a burden on the healthcare system by going into the hospital. So I want to end there. I think the statement on this slide is really true. Patients need us now more than ever. I hope you can see the impact that the Leukemia and Lymphoma Society has had. I will tell you that Gleevec is a good example of something else we pride ourselves in, and that is the treatments we have developed for the blood cancers are now paying benefit for patients with other forms of cancer. Gleevec is now approved by the FDA for 10 different diseases, including several solid tumors. And I mentioned CAR T immunotherapy, pioneered in the blood cancers, now being tested in virtually every solid tumor that you can think of. I don't have a crystal ball. I'm not sure whether it's going to work in those, but my scientific and medical gut says that it will. Happy to tell you more about the Leukemia and Lymphoma Society. Please feel free to contact Vanessa White, who's my colleague and is also listening into this call, or contact me directly. And thank you very much for the time.
Thank you. Thank you, Dr. Liu, for telling us about some of the groundbreaking results that the organization has had. If you'd like to get in touch with LLS or Just Capital, I remind you it's justcapital.com or LLS.org. And with that, I'd like to turn the mic over, the virtual mic, to Kunjan Mehta, who is going to be our moderator today for our panel discussion. So thank you, Martin, and thank you, Dr. Liu.
Thank you, Ali. Can you hear me all right?
Yep.
Okay. All right.
Thanks,
Well,
appreciate it.
Yeah. Thank you, Martin and Lou, Dr. Liu. Appreciate the time and the background. Hey, for everyone who don't know me here, I am Kunjan Mehta. I am the Vice President of the Roundtable. And for my day job, I'm a partner at Grant Thornton in our audit, financial services, and asset management group. Before we start the discussion, I would like to quickly introduce our speakers for the day today, Scott Hardy and Jonathan Traub. Scott is a partner at Alston & Birch Federal and International Tax Group, where he focuses on complex domestic and cross-border commercial transactions, including taxable and free mergers and acquisitions, joint ventures, and corporate restructuring. He has broad industry experience and works with publicly traded companies, private equity funds, closely held businesses, and large tax-exempt entities in structuring and negotiating M&A and other strategic transactions. He also represents clients in domestic and international tax controversy matters, including administrative audits and appeals before the IRS, as well as negotiation and settlement of taxes and civil penalties. He has been recognized by the Chambers USA and Best Lawyers in America as one of the leading tax lawyers in Georgia. Jonathan Traub is a managing principal of the Tax Policy Group in Deloitte's Washington National Tax Office, where he provides the firm's clients with critical insights on developments in tax policy and politics, helping them plan for anticipated legislation and potential impacts on their businesses. Prior to joining Deloitte, he was the staff director for the Committee on Ways and Means of the U.S. House of Representatives. During his tenure as the staff director for the Committee on Ways and Means, he was responsible for developing legislative policies and strategy on issues in the committee's jurisdiction, including taxes, healthcare, and trade. And Jonathan is a frequent speaker at events sponsored by Tax Executives Institute, Tax Council Policy Institute, and other tax-focused organizations. He's a board member of the Tax Council. His insights on tax policy frequently appear in the Wall Street Journal, Business Insider, Politico, and Washington Post articles. So with that, Jonathan and Scott, welcome to the roundtable. Thank you for being here. Appreciate it. Let's start with I guess this year, Joe Biden will take office next year, and this is probably one of the most robust and ambitious tax plans in recent history, right? And with the Democrats not making more sweeping election gains, it kind of blunts their potential for more transformational proposals. So, but what are your thoughts? Maybe we'll start with Jonathan. Give us an overview, a general overview of possible changes in policies with the Biden administration.
Yeah, I mean, I think that summary is generally correct with the caveat that we actually don't know who won the election. As those of you who have not been living under rocks, which is where I think we'd all like to be rather than living in 2020, know that Georgia has 2 runoff elections on January 5th. If Democrats manage to win both of those races, and the if is doing a lot of work in that sentence, They would get to 50-50 in the Senate. In a 50-50 environment, the vice president breaks the tie. And so if Democrats can win both those Senate races, they get a thin but functional control of the Senate, which could unlock the budget tool known as budget reconciliation, which allows them to pass major tax and spending bills out of that chamber with just 51 votes. And so while Biden did propose a very sweeping agenda of a roughly, depending on how you calculate it, between 3 and 4 trillion in gross tax increases, not to pay down the deficit, of course, but to pay for other spending and other tax priorities, not all those things could get done in a 50-50 environment, but many of them could. And so I think those who expected the 2021 would be the biggest year in tax policy in the last several years, don't give up hope yet, or don't celebrate yet, depending on your perspective, because the Georgia races could definitely have a big impact on what can get done next year.
And I would say, just from the client's perspective, there is anxiety around that Georgia race and the potential implications. So to the extent we're working on year-end transactions, there's a good bit of anxiety to try and get deals closed now. Maybe there's a little bit of hesitation in that they don't know that Georgia will swing the other way, because you have 2 races. So any one race could keep the Senate in Republican control. But nonetheless, there's enough uncertainty there that year-end transactions are trying to move forward and get closed. There's a big push. There's a particular concern about retroactive tax increases to January 1. So even if you were to push a transaction into early part of January, but prior to inauguration, is there a potential that they're facing a new rate environment in that instance?
Yeah, Scott raises a really important question there. And what I've been telling clients is the risk that Congress would in 2021 raise the tax rate retroactively back to January 1 of 21 is very small, but it's not zero. So I've advised people, if you have what you think of friction-free ways of realizing income this year or deferring deductions into next year, that are really sort of more timing differences than actual functional changes. I don't know why you wouldn't go ahead and make those changes or complete those deals now, just because there is a chance, albeit a very small one, that a tax rate increase would occur retroactively back to 1/1/21.
Well, I would say, I'm curious, doesn't the fact that the Democrats didn't win with a strong performance change the timeline of that? Do you think the priorities now change where, addressing COVID becomes a priority over tax increases and the retroactive tax increases?
So I do think that the first job out of the box is addressing COVID and relatedly addressing the economic destruction the pandemic has had on the economy. And even if the Democrats do manage to win both those Georgia Senate races, I don't think the first bill out of the box is tax increases. In fact, the first bill out of the box is likely further tax cuts and spending increases to get the economy through the pandemic. But then we get to the sort of a second bite at the apple Democrats would have at the end of next year on a second reconciliation bill. And that bill might include tax increases. And then the question becomes, as Scott raised, could those be retroactive to 1/1/21? And normally, when Congress raises taxes, they do so prospectively, either from date of enactment, the next calendar quarter, the next calendar year. But there are some examples in relatively recent history, including the corporate tax rate increase of 1993 that was enacted in August, I believe, but was retroactive back to 1/1/93. So it is not inconceivable Congress might make something retroactive. Again, I think the odds are small, especially if you're dealing with a 50-50 environment. Keeping all 50 senators in the wheelbarrow at the same time. Think about putting 50 frogs in a wheelbarrow and saying, nobody jump, right? It's really hard to keep your most progressive member from saying, this needs to be more progressive. It's very hard to keep your most liberal member from saying, or your most conservative member from saying, this goes too far. But if you can keep all 50 in a wheelbarrow, you can get tax increases through to pay for other spending. But my point is, it'd be hard to convince members to do not only an increase, but make it retroactive. So the odds are small, Kunjan. You're right, but they're not zero. So again, I wouldn't say sell your estate in Malibu, sell your business at fire sale prices. That would be a mistake. But if you are engaging in a transaction anyhow, and you can complete it before the end of the year, or you can defer deductions in the next year, I think if it's cost free to do so, why would you not do that just to avoid the risk that rates would go up retroactively?
Yeah. I think a couple of things that Jonathan, you just pointed up to gives some clients comfort, which is to say you've got moderate, let's say Democrats that may not go along with a retroactive change to Jan 1, which could be viewed as unfair depending on your perspective. So maybe someone like a Manchin or probably several others just may not sign on to that, but may be on board for a perspective change. And then, I guess just in terms of if they were going to do that, would they telegraph it? I don't recall 93, but was that kind of telegraphed ahead of time that the retroactive change was kind of baked in, so to
I
speak?
believe they did. I believe it was. So they said as bills were introduced, they said they noted a 1/1/93 effective date. But you're
Okay.
right, Joe Manchin. We're all going to watch Joe Manchin like a hawk. He is the senator from West Virginia, pretty much unarguably the most conservative Democrat in the Senate, and we'll all become Manchinologists trying to figure out every utterance he makes. Does this mean he could support the tax increase? Would he oppose it? And then he's going to be the center of political gravity for some time in a 50-50 world.
Yeah. Well, with the Senate, as you mentioned, with the Georgia election still pending, right? There's a big possibility of a gridlock, and so likely more modest priorities will take over, right? So I guess you anticipate stimulus and government funding and tax priority from horse trading, if you would, infrastructure maybe to take priority over some of the other measures, I guess.
I think that's right. The other thing I'll say, though, just again, if you were either hoping for or fearing a blue wave, which didn't materialize, don't take your eyes off the ball. I know this is going to make people on the call angry to hear, but think about what's going to happen in 2022. In the 2022 midterms, Democrats are defending really 3 seats, maybe 4 that could be competitive: New Hampshire, Arizona, Nevada. And then if you're really, really high, you could say as a Republican, you could compete on the offense in Colorado. But if you're in Colorado, you probably already are really, really high. Whereas Democrats will be playing offense in some very tough states for Republicans to defend: Wisconsin, open seats in Pennsylvania and North Carolina. Ohio's going to be competitive. Florida will be competitive. Maybe Missouri, maybe Iowa. So the blue wave that didn't show up on November 3rd could show up in 2 years. So just because the big things don't happen in these 2 years, don't assume it won't happen during the Biden presidency.
Yeah. So what tax increases are a priority? Maybe Scott, we'll start with you, right? Like, is it corporate income, capital gains, Social Security? What are some of the things that you see as a priority based on what we've discussed so far?
For the new administration, I guess probably the corporate rate increase going up to 28% is a pretty significant move.
Yeah.
I don't know, Jonathan probably can weigh in terms of priorities among these, but increasing rates on cap gains for wage earners over certain thresholds, and increasing the top marginal rate again to where it was before it came down a bit. Those seem to be kind of the priorities, but I wouldn't rule out also just renewables. So climate change is huge, and so there's a big push to kind of reinstate tax credits on renewables, which is to say investment tax credits, production tax credits, even carbon sequestration's got a lot of kind of momentum right now with new regs coming out. So I would expect to see quite a bit of movement in that regard as well.
Yeah, I would agree with all of that. The one other tax proposal, you mentioned the payroll tax increase, Kunjan, and I would say that's one not to really pay attention to. Due to the procedural quirks of reconciliation, it's very unlikely they could include a payroll tax increase in reconciliation, meaning it would require 60 votes to pass. If you think there's 60 votes among, in an evenly divided Senate, so you need 10 Republicans to vote for that, I would like to sell you a bridge or several bridges. The other proposal that Biden's talked a lot about that I would pay some attention to is a proposed minimum tax on companies with book income but no taxable income. He has often cited the concern about a number of brand name companies who report big profits to shareholders but then pay no taxes.
Yeah.
That sounds awesome on the campaign trail, but the reality of that is much harder to do. But it is a proposal that Biden comes back to again and again. So I would watch for that as an item if they're trying to cobble together revenue raisers to pay for climate. As Scott says, it's one of the things that Biden really cares about is some kind of climate package. I could see that something on the proposed alternative tax getting into that kind of a package.
Mm-hmm. Gunjan, I don't know, one issue that, since we were just talking about philanthropy, is just the estate tax.
Yes.
And, I don't know how high that registers on kind of the priority list, but, there's fairly significant proposal to reduce the exemption on the estate tax, which could have implications for philanthropy as
So
well. Probably.
effectively, from what I understand, and I'm not a tax expert like you too, but from what I understand, it'll go back from the 11 million that it is now to the original 5.5. But Jonathan, what do you think?
Actually, it goes lower because I think Biden would take it back to 2009 parameters, which would be the rate would go from 40 to 45%.
Okay.
And the exemption amount would go from 11.5 million down to 3.5. And then what's an open question is whether it's 3.5 indexed from 2009 forward, so it'd really be about 4.5, or whether he have it set at 3.5 in 2021 dollars, and that's sort of unclear from his campaign documents. I do think that's a proposal that we should be very much cognizant is likely to pass in a 50-50 environment.
Yeah.
One thing to keep in mind, Biden doesn't have a tax plan. He has plans for housing in rural America, in urban America, suburban America, exurban America, and all those plans have tax elements woven through them. And when you tease out all the details, if you jump through the rabbit hole, what emerges is a consistent desire to use a tax code to achieve some iteration of social justice, economic equality, and wealth redistribution. And the estate tax really scratches some of those itches for them. So if they get to a 50-50 or better situation for whatever reason, I could definitely see estate tax being one of the items they use to pay for, something they really like, whether it's climate or healthcare or free college or infrastructure.
Yeah, so utilize
I
estate
think-
tax to increase coverage of the number of families that basically fall within it.
Cover more families and impose the bite. And the other thing that we didn't mention is he also proposes to repeal step up in basis of death. And that's obviously a really important way that many high net worth individuals pass assets on to their children and other heirs without capital gains consequences, right? If you've got the appreciated value of ABC stock and you can sort of have that capital gain wiped out upon transfer, Biden says that's dynastic wealth that we don't like. He wants to repeal step in basis of death. That's probably harder to enact for a variety of reasons than the straight increase in the rate or a straight decrease in the exemption amount. But all of these proposals scratch real itches among Democrats to address concerns about income inequality and dynastic wealth. So they should be on your
I think that's if those are passed, then it would bode well for charitable giving and philanthropy, because what that drives now is anxiety among clients to try and do lifetime giving because they're worried about the rate or the exemption going down. So with a lower exemption, you do your lifetime transfers now, and then once that's passed, you have a potentially higher estate tax, and so that would encourage more charitable giving. So I think a lot of charities were at least opposing kind of the exemption increase back when that came in, and now would be in favor probably of cutting it back as an incentive to give.
I mean, and there's a weird case where I think about end of year planning, Scott, is if you were lucky enough to be in a position where you could pass $11.5 million to your kids, your grandkids, and not be worried that when you live out your years, you're going to be eating cat food or, begging for scraps on the street. Why wouldn't you do it now when the estate tax exemption is higher? Because I think we're pretty all confident that if the exemption amount goes down later, they're not going to claw back your gifts made when the exemption amount was higher. So it seems to me like one of those sort of places where if you have the wherewithal, and I would love for this problem to affect me personally, right? We all aspire to have this problem, but if it affects you, why wouldn't you make a large gift to your children or grandchildren or whatever now when the exemption amount is higher, just because it might go down next year?
Yeah, I think that makes sense. It's maybe the folks who are in the kind of the 20 to 50 range, or kind of who are not sure whether they would give the full amount quite yet, and it kind of pushes them into a tough decision. But you're right. I think you do want to, if you can take advantage of it now, you definitely want to do that. One of my partners had told me that in the history of the estate tax, it has never gone down. The exemption's only gone up. So it would be a first to go backwards, so to speak. But we've had a lot of firsts lately, so that's certainly possible.
That's great information. Thank you for sharing that, both of you. Let's pivot to federal taxes, right? So can you discuss the most significant changes within the asset management industry or for high net worth individuals that you anticipate? Taxes on corporations are anticipated to go up. limitation on interest expense deductions, fixed income and similar investment strategies will probably get affected. So what are your thoughts on those? Jonathan, maybe we'll start with you.
I mean, the one that we're all watching in this sector space is the taxation of carried interest, right? That's been the thing that Democrats have tried to go after, really, I think, for now 13 years.
Yeah.
And it's sort of been the cat with 13,000 lives. Every time you think, okay, this is the political alignment where we will finally see Congress enact a law that taxes carried interest as ordinary income, it doesn't happen. And so Biden campaigned on it, as candidly did President Trump, and it didn't happen. So is 2021 the year it finally happens? Maybe, but I kind of thought it would already have gone by now. So I don't know what makes this different than any prior year. But I think it's obviously something we're all going to watch very carefully.
Right. Scott?
I agree. I was curious if you potentially get to the same place in a sense, by raising the rate on cap gains above $1 million. So for wage earners over $1 million, you effectively tax cap gains as ordinary income. Does that maybe kind of a backdoor way of getting at not only carried interest, but just capital gains of high net worth earners anyway?
Yeah, I mean, the problem with that is that as a normal rule, if you raise the capital gains rate substantially, government loses money, which is not it's counterintuitive, but the government loses money because people say, I just won't sell my stocks anymore. I'll hold them longer. I won't sell my house to avoid the tax. And so to counteract that, a proposal is kicking around the U.S. Senate being offered by the man who would become chairman of the Finance Committee if the Senate gets to 50-50, a gentleman named Ron Wyden of Oregon, that would impose a mark-to-market taxation regime on capital assets, meaning we would look at your portfolio and then to the year and say, well, it went up by this many dollars. You owe tax on the unrealized gain. And I think it's just, to me, it's very hard. And I think that is a proposal to watch very carefully. But in a 50-50 environment, it's going to be really hard for me to see Congress agreeing to tax the unearned income or unrealized capital gains of investors and business owners. So you could increase the capital gains rate a little bit without triggering that deferral problem. I don't think you can get it all the way to ordinary income rates without having substantial, issues with people sort of extending their holding periods out there. So it would be a backdoor way of addressing that, Scott, but only if you also combine it with mark to market, which to me seems probably further than this Congress is likely to go.
What about, Jonathan, what about Section 199A, pass-through income being taxed at a higher percentage?
Yeah, so obviously a key piece of the 2017 Tax Cut and Jobs Act was a 199A deduction, which went to many owners of non-corporate businesses. It did not go to accounting firms. And I know, Kunjan, you and I, and actually Scott, are all really outraged by that gross travesty of justice committed by the Congress on us poor professional service firms. Biden has said he wants to phase it out for incomes over $400,000, and that seems to me to be a pretty viable proposal. I mean, I don't think people are going to lose a lot of sleep about saying we're not going to give you a 20% deduction if your income is already above $400,000. That doesn't strike you as the mom and pop owner of a laundromat or a restaurant that's really struggling to get by, who needs that tax advantage.
Yeah. And could the Congress tailor the rule to tax unrealized capital gains and the carried interest? Is that a possibility?
I mean, anything's possible. The other thing I would say there, though, Kunjan, that may be more relevant is watch what the regulatory agencies do in a closely divided Washington, where we expect less coming out of Congress than there would be if there had been this big sweeping concentration of power in one party or the other. What we've seen in recent years is presidents rely heavily on the regulatory rulemaking apparatus at Treasury or EPA or OSHA or HHS to achieve outcomes they can't get through the U.S. Congress. So I don't know whether a Biden Treasury could get to a point where they would be comfortable reclassifying carried interest as ordinary income for purposes of taxation. But for sure, they could make some changes around the margins that would affect the fund industry in ways that would probably be net not helpful.
So more reporting as opposed to higher tax rates, basically.
Well, potentially more reporting, potentially some income reclassification, potentially some holding period changes. I don't know what they would do exactly. I think we're all sort of trying to figure out the game plan for how far the regulatory authority goes.
Yeah.
Recent presidencies have been pretty willing to use their regulatory authority pretty aggressively to achieve outcomes and sort of say, you don't like it? Go ahead and sue me and see if you can win.
Yeah. I guess a lot depends on how much weight they can carry and what they can negotiate also.
Yes.
Yeah.
Scott, do you want to add anything to that?
No, I agree. I think, a couple of items with respect to administrative or regulatory action would be enforcement and what type of posture the administration would have in terms of enforcement. We did see just recently IRS moving towards hiring more auditors for partnership audits. So that's kind of already in the pipeline. Just kind of
Yeah.
curious what that might look like next year to the extent we see an enhanced audit activity. But you've seen, like you said, the use of the regulatory power to kind of push whatever the goals are of the administration. We did see recently with COVID, there was a lot of relief that came out. And I would say particularly in the renewable area, we had COVID, which was delaying a lot of projects. You had supply chain disruption, and Treasury came out with some guidance to help developers of solar projects or wind kind of get those projects timely completed. So they extended some deadlines. So I think we're likely to see some action taken as to which projects are adopted and how they use that regulatory power.
Right. So let's switch gears real quick to, state taxes, right? This is very helpful, update on federal. From a state standpoint, like how do you see that being impacted 2021 and onwards? Especially due to COVID, a lot of people have been working online. There's transition from, various tax charging states, let's say the states that are low tax or no tax. And there's probably going to be some impact of that over the period, anecdotal evidence of flight from high state tax during COVID. So maybe Scott, you could speak to that a little bit, and Jonathan can follow.
Mm-hmm. Yeah, I think there's two aspects to this. One is kind of just a COVID implication for state taxes. And then the other, maybe more, this is kind of ties into the regulatory piece. So I'll start with the regulatory piece, which is, we had the elimination of the state income tax deduction with the 2017 Act. Or it was dropped to 10,000, you're capped. And so that was very frustrating for a lot of people in high tax states. And recently, so there were several workarounds that states tried to pass. And one of them was an entity level tax, which the IRS has recently blessed. So it's essentially a kind of just a workaround that they blessed in a recent notice. So I think it's like 3 weeks ago. But if there's an entity level tax for a partnership, and it could be mandatory or elective, I think then that tax is deductible versus kind of having it be limited at the partner level. So just, it might be interesting to see whether there would be a proposal in Congress to kind of reinstate that deduction or somehow allow these more permissible workarounds so that taxpayers still get deductions for their state income taxes. On the COVID front, it's just, it's really complicated. There's a lot of people are having to work from home. A lot of people have moved to different states. I think the question is, how aggressive are states going to be with respect to going after revenue? And I think at least with respect to New York and some others, it's pretty aggressive because you have telecommuting where people maybe have gone to Florida or Connecticut or other states. They're working from there, and they're worried about, at least if you went to Connecticut, dual tax. If you've been up in Connecticut for 9 months effectively, I don't know the Connecticut rules, but I suspect you've either crossed over into residency there or you're pretty close. But New York has this kind of convenience of the employer rule that may allow someone, if they work remotely, they can still be taxed in the state because it's just a convenience of the employer. In the COVID world, it seems a little bit harder to argue that because there's basically mandates for people to stay at home and not come into the office. But New York has nonetheless said that they're going to still take that position, that even if you're working remotely, you're still subject to the convenience of the employer rule. And so New York is still going to tax you on it. Massachusetts has effectively done the same thing for residents working in New Hampshire. And I think there's a Supreme Court case. New Hampshire sued Massachusetts over that because Massachusetts is taxing its residents who are all working remotely. Yeah. So you've got serious state tax issues for individuals working remotely. And then kind of to layer on top of that is what are the corporate nexus issues for those businesses who have employees just scattered around the country where they may not otherwise have any nexus, but now, the CFO is working in, wherever, some other jurisdiction. And so you've got, I'd say a host of concerns for businesses and the employees that as of right now is uncertain as to how it's going to get resolved.
And concern for states as well, right? Because motivates employers to move out of the state eventually in the longer run. Jonathan, you got
I was going to say, Scott's exactly right about all of that. And the follow-on point is there's been an effort in the Senate to provide some certainty around these remote workers and how to tax them. And it's always been held up because Senate Democratic leader Chuck Schumer from New York has been defending the state's interest. The state, as Scott noted, is the most aggressive in tracking down those who may have even changed planes at LaGuardia, let alone actually had an office in the state. And so there is some hope that there might be a breakthrough to deal with the sort of coronavirus-related dislocation of the workforce, but so far that's been elusive, and it's going to be a vexing problem on April 15th of next year for millions of employers and millions of employees.
Yeah. Well, we have another 5 minutes. So what I want to do is maybe throw one more question at both of you, and then see if any questions from the audience. But I want to be respectful of everyone's time. So international taxes, right? Does this, what do you anticipate in terms of the new administration and the changes in policies impacting international business, especially within asset management? If there's any, do you see any impact from that standpoint? Maybe structuring changes too. I don't know what you think about that.
I'll mention two things that you should probably pay attention to. One is Biden's proposed a variety of changes to raise taxes on multinationals. And I think for the most part, what might emerge from Congress is actually the opposite, which is tax cuts for companies that brings jobs back home. The pandemic has shown a lot of Americans the extent to which we are reliant on other nations, largely not exclusively China, for not just drugs and masks, but everyday consumer goods. And there's generally an interest in having more subsidies to do domestic manufacturing. I don't think those things would be big enough to cause companies to uproot their supply chains. These are very complex organisms and built up over time. But I think Congress might pat itself on the back and say, we tried to help promote American manufacturing. Don't we all feel really good about that? And the other thing to watch is this OECD project, the Organization for Economic Cooperation and Development, is this ongoing effort to sort of harmonize global rules around taxing digital income and imposing minimum taxes on companies who are sort of using tax havens to move money around. That project will go on regardless of who's president. I don't think Biden's approach will be dramatically different than Trump's. But generally speaking, politicians in both parties have viewed this as a money grab by Paris and London and Brussels at the expense of Washington, D.C. So I don't expect we to have a huge negotiating change in posture, but we'll have to see who Biden actually puts into key negotiating positions to deal with the OECD and this ongoing Pillar 1 and Pillar 2 project.
Right. Scott?
Yeah, it's hard to say. I mean, the 2017 Tax Act on international was, seismic. And so now to come in, and it's taken 3 years just to digest a little bit of it. And now we're going to go tinker with it again. I can't even imagine the ripple effect with respect to, the models that firms have done around foreign tax credits and guilty inclusions and subpart F and the planning that's gone around that have, I can't even imagine how much it's been. And now to, propose changes to guilty and changes to the, corporate tax rate is just going to have a ripple effect through the firms that you and Jonathan's firm are going to be doing a number of exercises to try and see whether new planning is needed.
Yeah, so I had a colleague who said the real name of the bill is not the Tax Cut and Jobs Act. It's really the Tax Jobs and Cuts Act, because it is really full of employment for tax attorneys or tax practitioners.
Yeah.
Well, go ahead, Scott.
No, go ahead.
I was just going to say, it's 1 o'clock, and what I want to do is I want to ask maybe give your thoughts about any other important topics to watch out for next year and going forward. Scott, go ahead, Jonathan.
I would just mention, I saw this question come in the chat box about the temporary deduction that came in this year for COVID. There's an effort going on to extend that and expand it into next year as well. There is always bipartisan interest in increasing incentives for charitable contributions. I don't know that those things become law, but certainly we'll be keeping an eye on that one. At the margins, it's marginally helpful to help give people what it really amounts to an increase in the standard deduction, because it's not like the IRS is going to itemize people for a $300 claim deduction. So it's basically the increasing the standard deduction by another name. I watch that, and I would certainly watch who Biden puts in key regulatory positions, because that's going to be deciding so much of the tax agenda for the next 2 years.
Yeah,
Mhm.
that's great.
Yeah, I think just on this would be from the kind of the client perspective with respect to transactions. I would keep an eye on the growing use of indemnity insurance in deals. We've seen a lot of that in the last couple of years. It has grown dramatically in tax, and we have seen it in the fund world this year. So we've started to see funds get insurance for investments to protect against character conversion or other types of transactions. So I think that if you haven't heard of it, just be on the watch, because you're likely to hear about it. Its prevalence has been fairly significant in the market.
Yeah. Well, thank you both of you. This is great. We barely touched the surface, right? There's so many different things going on. But these are some very good thoughts and important items to think about and discuss as we go into the next year. So we appreciate your time and you sharing your knowledge and expertise with us here on the panel. With this, we will conclude. I think there's one more question, but I'm not sure we have time for it. So maybe we'll send it to you via email or online communication. Thank you, Jonathan and Scott, for your insights. The Roundtable's next event is our pre-holiday virtual cocktail networking event, and will take place this Wednesday evening on December 9th at 5:30. We hope you all can join us, and we hope you enjoyed the discussion today. Thank you, everyone, for being here, and appreciate everyone's time. Have a good rest of the day, everybody.